Welcome to Money Talk Viewpoint. I'm Chantel Leeson, your host. We're the talk show for investors and financial professionals who want to have that opportunity to provide the best opportunity for you to make the most of your money. I have guest speakers on my show every month, and we look for opportunity to show you something new to grow your wealth. Today, I have the privilege of having Victor. Pronounce your last name for our audience.
It's Chukwuemeka.
And tell them, now Victor lives in England, so tell him where you are from and where you originate from.
Right, so I originate, my parents from Nigeria. I originate from Nigeria, and that's where the family comes from. But I actually was born in Switzerland. My father was a cardiologist. He was a consultant cardiologist and went to study in Germany shortly after the war, Second World War. And I was born in Switzerland, quite some time after that. And I moved to England to generally go to boarding schools here. I grew up here. It's a fantastic place to live. It's a great place to be. It's a really good place to educate yourself as well. Education in the United Kingdom is free, but if you choose to pay for it, you can pay for it. But yeah, I grew up here. It was fantastic. Had a great time. Went to university, started my career out, which I'll talk about a little bit later. And yeah, but that's where we're from. But we are now naturalized British citizens. Not quite denounced our Nigerian roots, but we always have to remember those. But we are British citizens, myself and my brothers and sisters, my siblings.
Well, tell me, listen, now, where'd you go to university?
I was at University of London, so I studied economics. My bachelor's was in economics, and I graduated and went straight into the investment banking shortly after that.
And who did you work for?
I started working at Lehman Brothers.
Oh, okay, wonderful.
Yes, I started working at Lehman Brothers. Yes, so just way before the crash. So I started working at Lehman Brothers. I was there for a short while. One thing I wanted to do was to have a really good training experience in an investment bank that allowed you to sit and train I generally thought that the Lehman Brothers graduate training program was very rigorous. It was very, very rough. It was very sort of so quick. So I got a phone call from Barclays Capital to work as a foreign exchange trader. And that was where my sort of career took off. I was trading something called spot foreign exchange, trading dollar Swiss franc. So I was trading sort of tens of millions of dollars every day. I was on what they call the B desk. It was great fun. I had great people to work with. It was a very, very fast-flowing market. Most of the stuff came out of the US, or sales figures and interest rate figures and all that sort of stuff. And that's where I started to learn my education, how to think quickly on my feet, how to look at numbers. Numbers is my most important. I love numbers. This is why I'm here talking about money to you. So that's where I started. Yeah, foreign exchange trading at Barclays Capital.
You know, and you also went on for your PhD. Now tell us about where you went to go for your PhD.
Right. So my PhD actually started when I was very young. I was about 17, 18 years old. And I thought to myself, because the European countries were thinking of having one exchange rate and one interest rate. This was the start of what they were thinking about merging these two tools together. And I thought to myself, at the age of 17, didn't really know that much about economics. But one thing I did know is that if two countries have the same exchange rate and the same interest rates, if an economic shock happens, how are those two countries with the same economic tools able to adjust themselves properly to be able to get out of any mess that they're in? And I promised myself that someday I'm going to study and make sure that I can prove this phenomenon to be absolutely accurate. And I waited about 30 years later. I finished in the investment banks and I said, well, I'm going to study a PhD because now there's more than enough data to be able to do this. So I had 10 years data before the EMU. So that was 1989-ish to 1999. The EMU started in 99. And I had 10 years data from 1999 to 2008, 2009. And I did a comparison between both sets of figures, both sets of timescales, to see how countries adjust when economic shocks happen. So if a country adjusted better after the economic shock, it showed that, well, they didn't actually adjust, but if they adjusted better before the economic shock, it showed that the euro was probably not the best thing to happen. Because if you have a common interest rate, a common exchange rate, how can you adjust your balances sufficiently enough when maybe, say, Austria needs to increase their interest rates by 5%, whereas Germany only needs to 3%. So where are they going to go? So I knew that at the age of 17 to 18, this is not really going to work. So I set out to prove that. And one thing that we have got so far that we can see is the economic shock that happened in 2008, the financial crisis, has rendered these countries very inflexible. They're not flexible enough to be able to adjust their imbalances. And therefore, countries like the United Kingdom, who trade 44% of our trade is with the EU, we, between 2008 and so around the COVID time, had interest rates that were so low because we couldn't really trade, we just were not growing fast enough. And that's a lot of reason because we were, a lot of our trade is with the European Union. And unfortunately, it has rendered these countries, particularly Spain, my wife is from Spain, and we were there all the time, and we can see the economic problems that they have there since 2008 has just rendered them rigid. They're really rigid. It's a very, very inflexible country. There are people there, and I'm not saying that this is a bad thing, but there are people there who had jobs in industry, heads of markets, etc., who find themselves sort of going out into the fields, sort of picking oranges for 30 euros a day, because there just is not an economy. The shock has been so great for them that they have not been able to get back into equilibrium. So I proved that what I thought 30 years ago was going to happen did happen. And a lot of these European countries just cannot adjust. And that's why the PhD came about. I did that at Greenwich University. I took 3.5 years out to do that. I graduated PhD. I was very happy. And that's when I started to go into more consulting route to be able to help investors, help fund managers, asset managers, all these kind of people in their work. I got a phone call from a gentleman who said, I see you've got a really good experience in forecasting economics, econometrics. Could you come and help me in this real estate business? So he set me up in this real estate consultancy. I learned all about real estate, etc. And I started my real estate consultancy from there. That's how I got into it. So I guess my job title would be an economist, econometric forecasting expert in the real estate business, the real estate industry, I should say.
You've quite a very, very thorough experience and background. Where did you graduate your PhD from? Which university?
It was Greenwich Business School.
Oh, okay.
So it's in London. Yes. Yeah, it's in London.
I'm going to put you on a private view just so the audience can just see you. I'm take myself off. And I'm going to ask you a couple other questions. I must say, if I'm looking at myself as the audience, I'm sure they are very impressed with your background, your family background, your knowledge. You've worked for Lehman Brothers, so you've worked from firms we understand in the U.S. But I want to ask at this point, I'm putting you just on you, let you speak at this point. Share us what motivated you to get into your work.